Hey everyone, welcome back to the channel with me, Fawad Razaqzada, StoneX market analyst. Today we're looking at gold because it has slipped back below that $5,000 level after a volatile start to the week. The key question is whether this is simply consolidation or the early stages of a deeper pullback. In this update, we look at the price action, the macro drivers, and the critical technical levels shaping the near-term outlook for gold prices. Let's get into it. At the time of this recording, gold was down about 3% so far this week, reversing last week's mild gains. Prices briefly traded above the 5,000 per ounce mark early on Monday, but that momentum faded quickly with losses continuing into Tuesday. With the US markets now fully active but reduced participation from Chinese markets due to the Lunar New Year celebrations there, we could be in for some choppy price action this week, particularly ahead of key economic data later on in the week. There's still no clear consensus on whether the late January decline marked a cyclical top for gold prices. While buyers have stepped in on the dips, prices remain well below recent highs, suggesting reduced upside momentum. At the same time, the market is not showing strong bearish conviction, leaving gold broadly neutral in the near term. On the fundamental side, several tailwinds that supported gold earlier in the year are beginning to soften, but that hasn't stopped China's central bank from accumulating even more gold at its reserves. The People's Bank of China has now added to its reserves for the 15th consecutive month. However, expectations around US monetary policy have shifted somewhat, and this is where the recent pressure on gold has come from. Markets have pushed back their earlier optimism for aggressive rate cuts after Donald Trump named Kevin Warsh as the next Federal Reserve Chair, a move the markets interpreted as being a little bit more on the hawkish side. Since then, economic data has been mixed, creating uncertainty around the future interest rate path. The US dollar has not fully reflected this yet, but sustained strength in the US dollar could act as a headwind for gold prices. From a technical standpoint, we are seeing a few lower highs emerge, which is not a great sign, but so far the downside has been limited. The $5,000 level remains the primary pivot. A sustained move back above that would indicate improving sentiment and could open the path towards 5,100 and possibly beyond. However, a failure to reclaim that level increases the probability of further downside, particularly if incoming US data strengthens or we see geopolitical risks continue to ease. On the downside, initial support sits at around 4,800. A break below that could expose the 4,700 level, followed by the longer-term 4,500 support level, which is a very important level indeed. So, how do you trade gold in this environment? Well, overall, the recent volatility does increase the downside risks while also providing plenty of the buying opportunities. With gold swinging sharply in both directions, this remains very much a market where discipline is essential. Traders should take it from one level to the next, define clear targets, and keep risk management at the forefront of your minds. In conditions like these, volatility can present opportunity, but only when handled with care. If you found this useful, hit the like button and subscribe for analysis on commodities, currencies, indices, and also macro trends. Thanks for watching, and I'll see you in the next one. Take care.